The world is changing, and investors around the world are becoming more sophisticated, demanding innovative solutions from wealth and asset managers. Combining our deep expertise and experience in both investment and wealth management, Manulife Investment Management offers fully integrated solutions spanning investment funds and pensions globally. Strategically positioned in key markets, our investment and client service operations are supported by seasoned investment professionals across the globe. Today, we are one of the leading global wealth and asset managers. What sets us apart is our 3 complementary global business lines to meet the unique needs of our clients. With our multi-product and multi-channel offerings, our retail investments arm brings institutional capabilities to retail investors, creating unparalleled investment solutions. While our institutional asset management arm provides a comprehensive suite of outcome-oriented solutions to institutions internationally. Our retirement arm offers an open architecture platform, which aims at providing best-in-class products and end-to-end solutions to meet the varied retirement needs. Leveraging the strength of our parent company, Manulife Financial Corporation, which has a rich heritage and investment track record that dates back to the 1800s. We have access to a wealth of experience. With our strong insurance pedigree, we manage risks in a strategic and dynamic way. In Asia, our unrivaled presence and deep understanding of the region enable us to offer strong local insights and flexibility in customizing solutions for every client. It is our unwavering commitment in Asia that makes us a trusted partner of many across the world. Leveraging our local level expertise, as well as extensive global resources and network, we deliver solid investment results not just in public markets, but also private markets. Our long track record and deep capabilities in private assets means you can tap into a diverse group of assets to meet your unique investment needs. Through our differentiated, value-added public and private asset offerings and capabilities, we punch above our weight in delivering outcome-oriented and goal-based investment solutions to our clients. We achieve excellence in Hong Kong, where we power the largest mandatory provident fund provider, Manulife, and China, where we are the first financial institution to receive the investment company wholly foreign-owned entity license. The Philippines, where we are the first trust corporation backed by a leading multinational financial services group. And Indonesia, where we were awarded the top fund house. And this sums up our commitment to you. Manulife Investment Management.
Now more than ever, healthcare has become a top priority. Benefit from this sector's robust growth opportunities. Manulife Global Healthcare Equity Feeder Fund, an equity UITF structured as a feeder fund that provides investment opportunities in healthcare-related companies listed globally. Invest now for as little as 5,000 pesos or $100. Talk to a Manulife Wealth Specialist today. Generate income from traditional and non-traditional assets. Benefit from a broad investment universe. Diversify your investment portfolio with Manulife Global Multi-Asset Diversified Income Feeder Fund, a unit investment trust fund that provides a flexible and diversified investment strategy, blending multiple income sources to maximize your returns. Invest now for as little as 50,000 pesos or $1,000. Talk to a Manulife Wealth Specialist today. Now more than ever, healthcare has become a top priority. Benefit from this sector's robust growth opportunities. Manulife Global Healthcare Equity Feeder Fund, an equity UITF structured as a feeder fund that provides investment opportunities in healthcare-related companies listed globally. Invest now for as little as 5,000 pesos or $100 US. Talk to a Manulife Wealth Specialist today. Generate income from traditional and non-traditional assets. Benefit from a broad investment universe. Diversify your investment portfolio with Manulife Global Multi-Asset Diversified Income Feeder Fund, a unit investment trust fund that provides a flexible and diversified investment strategy, blending multiple income sources to maximize your returns. Invest now for as little as 50,000 pesos or $1,000 US. Talk to a Manulife Wealth Specialist today.
Good afternoon, everyone. I am Yvette Carlos from the Wealth Sales team of Manulife Asset Management and Trust Corporation, and I will be your host today. 2020 was a volatile year for fixed income and equity markets as the pandemic impacted economies around the world. Today, we've invited two of our fund management experts from our global asset management arm, Manulife Investment Management, to talk about two new investment solutions for you to consider: a multi-asset and a global healthcare strategy. This webinar is part of our commitment to keep you informed of new strategies best positioned to withstand economic cycles. Our way to help make every day better for you. We are also giving away 5,000 pesos worth of investments to our best-in-class funds. So, this is to help you start your investment journey. Stay tuned for that. Now, let me now introduce our esteemed speakers for today. Live from Hong Kong, he graduated Bachelor of Arts in Business Studies and French from the University of Sheffield, United Kingdom. He is now Managing Director and Client Portfolio Manager with the Multi-Asset Solutions team, responsible for providing support to Manulife Investment Management's regional multi-channel sales distributions teams. He has 17 years of financial industry experience, including 13 years based in Asia. So he is indeed a seasoned investment professional. Ladies and gentlemen, please a warm welcome for Paul Calogiru.
Hi everyone, welcome to the webinar.
Up next, we should really thank him because I hear he didn't even sleep. He stayed up for us, all the way from Boston, where it's about 4:30 a.m. He graduated Bachelor of Science in Biology with honors from the University of Notre Dame, and then went on to take his MBA at the J.A.L. Kellogg Graduate School of Management, graduating with honors from Northwestern University. He is now the Managing Director and Lead Portfolio Manager for the Global Healthcare Strategy at Manulife Investment Management. His 35 years experience in healthcare and his background spans not only the investment management industry, but also private equity and corporate roles at leading healthcare companies. This includes Johnson & Johnson, Elan Pharmaceuticals, and Abbott Labs. Ladies and gentlemen, a warm welcome for Stephen Slaughter.
Good afternoon, Yvette. How are you? Nice to see you.
It's nice to see you too. Now, before we begin the program proper, I would like to encourage everyone to please join in on our conversation. Anytime you have a comment or a question that you would want to ask either of our guests, please go ahead and type in your thoughts in the Q&A box at the bottom right side of your screen. Our panelists will try to address as many, if not all, of your questions during the Q&A portion. I'm sure participants are all eager to hear from you both, so let's get started, shall we? Okay, for my first question, I'm sure our audience is very interested to know more about the funds and how it can help diversify their portfolios. Paul and Steve, can you tell us the features of your respective funds and what makes the strategies you employ unique? Also, what are the objectives of your fund? Okay, let's start with you, Paul.
Sure. Thank you, Yvette, and welcome everybody to this part of the seminar. I'm going to talk about the Global Multi-Asset Diversified Income Fund, or this part of the presentation. And I first want to go over the key fund features, just to summarize and just sort of set the scene. So the fund has sort of three key features. The first is to generate a high income, and that income is looking to generate around 7.2% income payout. So it's a pretty attractive income that we're distributing out to our clients. The second is to achieve this through a diversified portfolio of credits, equities, and options. And the third way of doing that is to enable us to try and do that with a sustainable NAV. The way we look to construct this portfolio and the way we aim to achieve those aims is through a portfolio that consists of three key asset classes. So the first component is a component of fixed income credits. That's around 50 to 55% of the portfolio. And that is a basket of credits of global high yield and emerging market debt credits. The second component is a basket of global equities. These are global, large cap, well-known names. They currently have a value cyclical orientation. And the third component is an interesting component. It's an option writing strategy where we write options on top of that basket of equities. So it's the interaction and the interplay amongst those three components that we believe makes this an interesting investment solution for our clients. So that's the sort of broad top level makeup of the portfolio. And as you can expect, in order to achieve those high yields that we're offering through this product, we have to have exposure to high yielding income generating credits, as well as high dividend paying equities, as well as harvesting those option premiums that we get from the option sleeve. So it's a global portfolio. It's a multi-asset portfolio. It's unconstrained in many ways across geography, sector, and quality of credit. So it's a go anywhere portfolio. And really what we're doing with this strategy is bringing together the resources and expertise that we have across our Manulife equity, fixed income, and multi-asset solutions desks in order to bring a coordinated multi-asset solutions income product to our client base. If we can go on to the next slide, please. Great. So what we've got here is, I think we've just gone through the sort of the key three features of the product across the top here. So we're looking to generate a very high income. It's an attractive 7% income that we're looking to pay out to our clients. Secondly, we're looking to do that through a globally diverse portfolio of assets. And third, we're looking to cushion some of that downside. Now, what we mean by that third point is that this portfolio does have that flexibility to allocate towards some of the higher quality areas of fixed income, such as IG. It has a flexibility to invest through REITs as well. And as I think we're all well aware of some of the defensive characteristics of REITs. And also the option writing strategy, where we can harvest some of that premium and we can generate some of that income. We can use some of that income to offset maybe some of the downside that we'll see in sort of the key pillars of the portfolio. So if we look across the middle of that slide, we have traditional income sources, and the bottom of that slide in blue, we have non-traditional income sources. So you're getting multiple traditional and non-income sources to really to get that income so we can pay out that income to our clients who are invested. So the traditional sources you're probably well aware of. On the left-hand side, you can see we have an IG component. This is high-quality IG global credits. And again, we don't have a lot of exposure in this portfolio to IG, simply because it doesn't get us to the yield that we want to get to. But it is an area that can provide some sort of risk stabilizer, or we can move exposure to these areas in times of distress. The second area is high yield, and obviously with high yield we can really generate that income through that high yield exposure. Thirdly is through exposure to emerging markets debt, and again a diversifier, getting that diversified exposure globally. I think also it's worth pointing out that that emerging markets bucket is largely US dollar denominated credits. So there are some local credits in there, but it's quite a small allocation. So there's around a 2% allocation overall in terms of local EM debt credits in there. And the fourth part is the global equity component. As I said, these are large cap global equities. They're well-known names with solid business models. And at the time, this portfolio is very much designed to benefit from the reopening of economies and benefit from that value cyclical uplift that we're seeing recently in markets. So if we move on to the non-traditional income sources, preferred securities that we have in this portfolio, we have a handful of exposure to preferred securities. It should be noted that Manulife are one of the top 5 managers of preferred securities in the US. So these are hybrid securities. They're higher up the capital structure. They're higher up the capital structure than equity. They provide attractive yields, and we, as I say, we have a small allocation to these securities, and they give us a reasonable yield, and they're generally issued through from IG issuances as well. The REIT component, I think we're well aware. You could argue it's a traditional income source, but these are a yield stabilizer. They have diversifying aspects. They are uncorrelated to some of the other asset classes that we have in this portfolio, and they have defensive characteristics. And the other component, I think, is an interesting component that is a key differentiator here, is the option writing strategy. So here it should be noted that we are selling options here. They're covered calls and they're collateralized puts. So this option strategy is very much used to generate income for the portfolio, or enhanced yield, or enhance that yield. So if we sell a call, we get an income for the portfolio. If we sell a put, we get income for the portfolio as well. And in many ways, it's that exposure across all these asset classes which sort of brings together the strengths of our organization. So I'll stop there in terms of giving you a broad overview of the multi-asset diversified income solution, and I'll hand back to you, Yvette, if I can.
Thank you for that, Paul. Given today's low interest rate environment, enjoying favorable yields on one's investments can really be challenging. So it's a good thing that we have a solution that can provide investors a multi-asset investment approach that will enable them to generate income even during these highly volatile times. Steve, can we turn to you, please?
Sure, thank you, Yvette. So I'd love to give you a little overview now of the Manulife Healthcare Fund. It's an equity fund and an equity strategy with multi-billion dollars under management. Our objective with the fund is to provide capital growth. We're looking for equity returns as well as dividend returns across a broad, diversified portfolio of healthcare stocks. So we have a long-only approach here. We do buy and hold with an average hold period of somewhere between 3 to 5 years. It's a disciplined portfolio, but a concentrated portfolio. Roughly 50 names that we brought into the fold. And it is diversified. So we go across geographies. We own Asian equities, US equities, European equities, and diversified as well across cap. So all the way from small cap up to mega cap. This portfolio, I think, is unique in a couple ways. That number one, we do have a very seasoned team that manages this money. As lead portfolio manager, I have 4 colleagues that I work with on a daily basis who are committed to this product, including one gentleman on the line tonight, AJ Quigley, has over 15 years of experience as our client portfolio manager and is a key contact for us with our channel intermediaries. Secondly, a gentleman in London by the name of Will Hamlin. Will is a 20-year investor with exceptional experience in healthcare. His primary responsibilities include the Asian equities as well as the European equities. Third on the team, a relatively new member, CJ Sylvester. CJ joined us last year, over 25 years of healthcare experience, and his forte, if you will, is biopharma names. So a terrific, seasoned investor with great insights on the advances coming forward in the biopharmaceutical industry, and a wonderful addition to the team. Lastly, but certainly not least, a gentleman from Chicago, Travis Schaffner. Travis has over 25 years of investment experience as well. I had the good pleasure of working with him many, many years ago at UBS. He is our small cap specialist, so focusing on some of these emerging companies, including many of the new IPOs that we see in our space. And there have been literally 300 IPOs in healthcare over the last 5 years. So a lot of fertile ground from which to choose new equities. The approach we take is what I think is fairly unique. If we think about a differentiated portfolio, I think the process by which we build this portfolio is somewhat unique. It is, as I mentioned, a high conviction portfolio, but we do a very bottoms up fundamental research process here. So we are trying to find stocks that bring forth products and services that address three guiding principles. Those guiding principles are, number one, we're looking for companies with unmet medical needs, products that can address those big problems in healthcare today. Secondly, we look for products and services that address underappreciated markets, so market opportunities that perhaps the market hasn't fully priced in yet. So we spend a lot of time looking for those. Thirdly, and equally important too, we're also looking for equities that have products and services that can bend the healthcare cost curve. And we'll talk a little bit about that in future slides here, but an important factor as we think about global expenditures against healthcare. Suffice it to say, companies that can bring forward products that check 1, 2, or 3 of those boxes generally are going to be interesting investment opportunities. We do our research through, again, a fundamental bottoms-up approach. So we spend a lot of time talking to scientific thought leaders, medical thought leaders. We scan the scientific literature. We talk to physicians. We talk to payers. Oftentimes as well, we'll spend time with the researchers themselves working on these new drugs. So to the extent that we have an opportunity to enlighten ourselves and better inform our models, that is a fruitful exercise, and one that I think is differentiated in a field where many people don't get into the weeds, so to speak. We tend to do that, and several of us have scientific backgrounds that afford us the luxury of doing so. Lastly, maybe in terms of the portfolio itself, we find interesting stocks. But we also do a fairly disciplined intrinsic valuation. We're looking for growth stocks to add to our portfolio, but we also want to find those growth stocks that have upside, that have underappreciated revenues and profits. And we do a discounted cash flow model for those companies to determine what we think fair value is. And if we see fair value well above what the market's willing to price in for a particular equity, those are the stocks that we're likely to put into the portfolio. So we assemble a portfolio, again, with an eye towards returns, but I'd add as well with a real focus, too, on minimizing risk. Many of our clients are retirees, and we're trying to generate good returns on capital, good dividend streams as well, but with an eye towards minimizing risk. So the portfolio that we've assembled, I think, is somewhat unique in that regard, that we're not just chasing growth for growth's sake, as so many sectors have in recent years, but we're finding great growth names at rational valuations that afford us some comfort that over that full market cycle, through the ups and downs of the market, we can generate consistent and strong returns for our clients. So with that, I'll turn it back to you.
Okay, thank you, Steve. So when you mention IG, you mean investment grade, right? It's for our audience who's not familiar with the terms. Yes.
Yeah, that's me.
Thank you.
You bet.
Okay, so the healthcare sector, Steve, indeed offers exciting growth potential, especially at this time when its value to economies and societies has become more important, now more than ever, right? Okay, so for my next question, it's no secret that COVID-19 has changed people's lives and the way we live it. So and unfortunately, it has also affected most, if not all of people's investment portfolios. So, could you let our audience know how the pandemic has affected your respective funds' performances and how you've managed to deliver positive returns amid these market volatilities? Maybe we can start with you first, Steve.
Happy to do so. But if I could, maybe my next slide. As you can see here, the year of calendar 2020 was a remarkable year. We had wide divergence across sectors within the economy in terms of returns on equities. And even within our healthcare sector, we saw some fairly wide divergence from certain subsectors within, as you see on the chart on the right. We did perform relatively in line with the market. The healthcare sector did in 2020. But it was kind of a series of fits and starts, frankly. I might turn to just my next slide if I could. 2020, we started into the year coming off of 2019 with some very strong performance in the fourth quarter. I think a tailwind for the sector with, amongst other things, people anticipating continued earnings growth in a relatively calm environment. Given the strong returns we saw late in 2019, we actually did trim some of our more fairly valued holdings and added to some of our more attractive opportunities, some places where we continue to find good value in those growth equities. The pandemic came about, as we know, in first quarter. We did get a sense from our fundamental research that this pandemic was likely to occur about the third to fourth week of January. We actually kind of uncovered that and took some of those indicators and deployed that research to kind of reposition the portfolio. So we did lighten up on some of the more volatile stocks, moved a bit more into cash, and positioned ourselves for what eventually was the drop kind of in that mid-February to late February timeframe. Additionally, then, when stocks began to recover in the March-April timeframe, in large part driven by some really large stimulus, as we all know, from central banks, driving equity markets higher as they continued to kind of suppress the bond yields, we were able to reposition that capital and I think kind of rotate back into some stronger names, some higher growth names, and towards the end of the year saw some very consistent and upward performance. So pleased to have navigated some fairly choppy waters here in 2020. The pandemic itself had a macro impact on our portfolio, but I also add, maybe with the next slide, that it had some specific impacts on how we position certain equities. Looking at our next slide, thank you. COVID-19 emerged as a large unmet need, as we all know. And we did take the opportunity through our fundamental research to spend some time looking closely at three main categories of opportunity. As we all know, the therapeutics that came along early on in the pandemic provided sort of a bridge, if you will, to help patients navigate the disease and hopefully a bridge to the vaccines. And we were fortunate enough to find some interesting investment opportunities around those therapeutics that we folded into the portfolio. Secondly, diagnostic testing, a very important factor as we thought about 2020 and the ability to kind of get this pandemic under control. The testing opportunities that we saw, particularly in the two modalities, PCR and antigen, we thought were going to be profound, and we actually continue to believe may be a longer-tailed opportunity for companies selling products into those particular markets. So we have increased our exposure to some of those names, and I think fortunately provided us some good returns in 2020. And lastly, vaccines. Everyone's focused now, obviously, on the rollout of the vaccines. As many of you know, there are a number, 6 now approved globally. We happen to have 3 of the vaccines approved here in the United States, and hopefully more coming in all developed markets. We see that as a watershed event in the history of drug development, frankly. The fact that the companies were able to stand these programs up with such rapidity and with such success, frankly, it really, I think, portends not just excellent opportunities for us to invest, but it's important from a macro standpoint, right? it gives us hope that we can work our way out of this pandemic, move to more of an endemic stage with COVID-19. And towards that end, we have invested in a handful of these companies as well that we believe have intermediate to long-term prospects for continued revenue and growth and sales growth and profit. So with that as a backdrop, I guess I would turn it back to you, Yvette.
Thank you, Steve. I'm sure it's an added comfort for our audience to know that stock selection and our disciplined approach are key to the good performance that we've had despite a very challenging 2020. Paul, can we now turn to you, please?
Yeah. So I think I talked about some of the key features of this multi-asset portfolio. I think, as you say, Yvette, it's appropriate to talk about how we manage through volatilities and how we manage risk and how this portfolio has been able to navigate through those risks, particularly after the year that we've had. And just as Steve talked about, if we go back to March 2020, that period of time was a particularly distressed period of time, and it certainly tested the investment process of this particular portfolio, as it did with many asset classes globally. You saw at that period of time investors looking to sell anything and everything back to cash, and so it caused fairly large distortions in market prices. So what we learned from that period, and particularly what is relevant to this portfolio, is that some of the REIT and the preferred exposure that we had in this portfolio had higher beta than we would have expected. So some of these hybrid names, such as the preferreds and also some of the REITs, they acted very much like equities, and therefore we had to have some thinking and thoughts around those particular asset classes at the time. I think broadly speaking, in order to manage and navigate through the risks, this portfolio, as I've said, is a very diversified global portfolio. So there's around 220 fixed income names that are in this portfolio, and then there's an extra 110 equity names. There's a handful of REITs, so there's only a small portion of REITs in this portfolio, and there's a handful of preferred securities as well. So they're not the key drivers of the portfolio. And then on top of that, you have the option strategy written on top of the equity basket. So a very broad, diversified portfolio, which hopefully puts us in a very good position to navigate risks as we go through these sort of market cycles. A second key point regarding navigating volatilities is that focus on income. So the key primary objective of this portfolio is to generate that income for our clients. And in many ways, we don't want to be reliant on that distribution payout being a function of, say, appreciating equities, for example. So a large portion of the distribution payout is attributed or contributed from the natural underlying yield of credits and equities that we have in the portfolio. So that's key to remember. And I think on the top right-hand chart that you've got here, we break out that actual income breakdown. And you can see from the top right chart here that a large portion of the income that we pay out to our clients is from the options premium that are harvested. And then, as you can expect, the coupons from the fixed income bucket are also a large driver of that income as well. I should also highlight, in order to navigate risks, is that complementary options writing strategy. So we should view these two, the puts and the calls, as complementary and not sort of separate in themselves. And we talk about this buffering downside risk, and so we can talk about, what do we mean by that? So if, for example, you had a straight equity portfolio, a vanilla equity portfolio, obviously that would lose, that would have downside when markets come off. Similarly, the equity bucket in the GMADI strategy here would lose as well. However, you're going to have the income payments from the premiums. So, for example, if markets fall, you would retain the call premium that would be harvested from writing the call options, and some of that income you can help to offset against some of the losses that maybe you've had on the equity side. And then lastly, in order to manage that volatility, when we look at those fixed income credits, we're looking at some of the where we could get transparency on cash flows amongst those corporate credits. So, for example, you have business models such as telecoms and telecom services, and you get a better idea of where their cash flows are coming from, and therefore you have better transparency of their cash flows, and therefore you have a better ability to understand the sustainability of of them paying their coupon. So these are the type of industries that we look to invest in, and there's a fairly large weight towards telco services within the portfolio. There's also a fairly large weight towards those credits that have not been hugely impacted by the pandemic. So there's tech names in there, there's online business names in there, and food in there as well. So these areas that have helped navigate the portfolio through those distress periods that we had since March. And in many ways, as you can see from the slide in the top left, you saw how investors embraced risk from that March period, and we've had that rally from March 2020 into where we are now. So if we go on to the next slide, please. And just here, we just want to provide a snapshot of the performance of the portfolio. So over the last, this is to December 2020. So over the last 6 months, the portfolio has gained around 13%. And then if we look more recently into January, February, and more recently into March, that positive momentum in terms of performance has continued. So January of this year was a fairly soft month. February, we saw risk assets, spread assets improve, and that momentum continued. And then more recently into March, again, that positive returns have continued for March. And just finally, at the bottom of that slide, we just want to highlight sort of the key asset class components. And in many ways, it gives you an idea of where we're exposed to try and get that income generation through the portfolio. So there's around 50-55% exposure to fixed income credits. And as you can see, the risk here is on the credit side. So the exposures are through high yield credits and emerging market credits. There's very little exposure to IG bonds. The reason is because they don't give us that yield. And then we also have a handful of exposure to preferreds. On the equity side, as you can see, we've probably got around a 20-25%. We have now actually, it says around 18% exposure to global equities. We've added towards that exposure over the last couple of months, and we've took the options down a little bit. So that gives you sort of a broad overview of the portfolio. Hopefully gives you an idea of a snapshot of how we've managed risk and volatilities over the last year or so. I'll stop here and maybe I can hand back to you, Yvette.
Thank you, Paul. Thank you. 2020 was indeed a learning experience for all of us. And it's great to know that we have a strategy whose broad asset mix and innate diversity helped it get through the market volatilities it experienced last year. So with 2020 behind us, what can our audience look forward to this year and beyond? Can you share your respective outlooks and forecasts for this year, and maybe also impart to our audience any compelling reason why they should invest in your fund now? Paul, would you like to go first?
Sure. Okay. Yeah. So it's pretty interesting times, and what we've had over the last year or so, we've had pretty weak macro data. The pandemic has certainly impacted large parts of the economy. It's probably one of the worst years we've had macroeconomically. But saying that, assets markets, equity and debt markets have done pretty well. And the market has reacted fairly positively towards that fiscal deployment that we've got coming through from governments. It's reacted fairly positively towards the Fed, and I think overnight what we had from Chairman Powell, that was also a positive reaction from markets in terms of the language and the guidance that the Fed gave us. The Fed are also wanting to run that economy towards that 2% inflation target. I think they're willing to run economies fairly hot to get there. And in many ways, they have rubber stamped that sort of steepening reflation story. And hopefully we get a pickup in economic activity as these economies reopen. So one of the key sort of elements of volatility that we had more recently was that sort of rise in yields testing the Fed, and then also the implications of potentially baking in higher inflation expectations into risk assets and into equities. Overnight, there's been a little bit of a change, and we can maybe talk about that a little bit later. But in terms of this portfolio here, and if we've got here on the fixed income side, I think ultimately, given the exposures to spread assets, we're pretty well positioned, and we're happy, sort of comfortable in terms of the positioning towards risk assets and including spread assets. So the rise in yields that we've had more recently haven't really impacted this portfolio that much. The reason why is because this portfolio has very little sovereign exposure or rate exposure. So the risk is not on the rate side for this portfolio. The risk is on the credit side. And ultimately, what we've had over this period is a stable credit environment where we've had actually tighter spreads, and high yield has been a reasonable bright spot in terms of the fixed income bucket. I should also mention about default rates. So, if we expect an economic environment that is improving, that we wouldn't expect another wave of defaults in 2021. So I think at this present time, we feel default rates have peaked out, and we expect those to come off over the next year. I think ultimately our fundamental analysis and some of the stress testing that takes place within our fixed income teams will help navigate some of the challenges that may arise over the year. So all in all, I think the indications point towards a continued extended period of low rates. Before this Fed the Fed overnight, I think we had a bit of uncertainty and concern about where rates would go and whether the Fed would exit sooner rather than later. And clearly that has now put those thoughts back on track in terms of the Fed and not looking to raise rates until 2023. So this is positive for risk assets and spread assets. A low rate environment is also positive for these type of strategies, income-oriented strategies where you have rates remaining low, the search for yield will continue, and these type of strategies, income-oriented strategies, should remain fairly well bid over the next couple of years. So if we go on to the next slide. Just in terms of equities, this portfolio is positioned for a reopening of economies. Now, historically, we did have some underperformance versus some of our peers, and that's because we didn't have that sort of positioning into some of the growth tech-oriented names, where some of our peers had high tech exposure, high US large cap exposure, high US convertible exposure. So very focused into certain specific asset classes. This portfolio here, in terms of the equity bucket, is a global portfolio, and again, as I mentioned, it's positioned for that value cyclical rotation, and so more recently, the portfolio has benefited from that trend that is appearing. The key question clearly is this a cyclical trend, or is it something more structural and more substantial where we can get that longer term value cyclical names doing better over the next couple of years or so. And then I think I should touch upon the options side. Now, as I've said before, the options sleeve is there to enhance yield and to produce that income for the portfolios. And just to give you an idea how the options strategy is written, currently we're writing out of the money call options and at the money put options. The closer to the money that you write the options, the higher the premiums. So what we tend to do is we tend to write them sort of 2 to 3% out of the money, so it enables the equity basket to maintain or have that participation in equity upside. But what we're trying to do here is harvest premiums now and maybe forego some of the future upside. And that option strategy can be managed quite tactically as well in terms of views and thoughts on certain sectors and at index level as well. So I think when we talk around key reasons why you would want to own this type of solution. So as I've said, it's a high generated income portfolio. You're going to get 7% income for this portfolio. You're also going to get a diversified asset base, exposure to a diversified asset base. And so that would probably be one of the key selling points for this fund. Yeah. So I'll stop there. And if I could hand back to Yvette. Thank you.
Thank you, Paul. Indeed, there are still a lot of challenges that this market is going to face. And, with the Fed announcement last night, it really changes your outlook moving forward for your funds. But you and I both know that with every volatility comes equal opportunity. So that's something that we know that you will be watching out for, both of you, for your funds. Can we now turn to Steve for your insights, please?
Thank you, Yvette. We are fairly bullish, frankly, on 2021. Coming into healthcare this year, we see kind of a number of tailwinds that we suspect are sustainable over an intermediate and even long term. Not the least of which I would point out is the valuations on a relative basis look terrific right now. If you look at historical norms, healthcare is trading at a fairly substantial discount to broader markets. Well, that has to do with just the huge run in tech, but even stalwarts that are strong cash flow generating companies with great earnings growth are trading at meaningful discounts, in particular in the biopharma space. So that is informed and continues to inform our portfolio construction. We look at our product, the fund that we've constructed. Again, we see a fairly unremitting demand due to just basic tailwinds of organic growth, and we'll talk a little bit more about that in a minute. But we continue to think that stock selection is the key here. Finding the right names and the right construct with the right earnings growth over time, we think will continue to generate strong returns and strong returns that are appropriately balanced for risk. If we go to the next slide, the macro tailwinds, I think, have been reflected in this sector for a long time. Just as a point of reference, and with the caveat that past performance does not predict future, but this sector has outperformed. It's meaningfully outperformed over 25 years. You can see here to the tune of roughly 300 basis points a year. And that outperformance, we think, shall continue in the future, just given the underpinnings and the fundamentals that we see in the companies that we're tracking, in the science that comes forward. I referenced COVID and just the remarkable turnaround times that we've had there to stand up testing and stand up therapeutics and stand up vaccines. I think that speaks to sort of a structural advantage of healthcare, that these companies can move quickly. And that tailwind, I think, will continue going forward. If you look at the second slide here, the next slide, please. It is remarkable, though, too, that we see that growth potential and that potential for outperformance over extended periods of time, but with a very strong defensive characteristic as well. As you see in meaningful downturns over the years, like the tech bubble unwinding 20 some odd years ago, the global financial crisis, we do see persistent outperformance of healthcare equities. We see it in large part, again, because the demand for healthcare is to a large extent inelastic. People are going to be sick in good times and bad, and in recessions and in bull markets. And to the extent that we see tailwinds there, not just in terms of demographics, but in terms of willingness of government payers to step forward and to support the use of health expenditures to prop up their populations. We think this is an attractive combination, great growth coupled with great downside protection. Next slide, please. So how do we see our subsectors? I mentioned biopharma, broadly defined, we see as very attractive right now. We have constructed, again, a portfolio here of companies with best-in-class products in those unmet medical needs, diseases like COVID, as we mentioned earlier, but cancer, diabetes, orphan diseases. We just see a lot of additional upside in diseases for which we just haven't made as many inroads as we have certain others, like cardiovascular, for example, over the last 20 years. We continue to monitor, too, the fallout from the recent U.S. presidential election. Just a point of reference, our benchmark's about 70% biopharma. And, to the extent that roughly half those revenues come from the U.S. market, we are very cognizant of the potential risk for change there, but frankly, continue to think that those changes will be incremental rather than groundbreaking or earth-shaking. We continue to see great earnings growth in a handful of these names, and accordingly, we've populated the portfolio with those. Secondly, healthcare equipment supplies, healthcare life science tools companies, very good fundamentals there. I would say, though, with certain deference to valuation, we have been disciplined here and not chasing growth just for growth's sake. We have continued to maintain a healthy weight here, but names that have outperformed and have reached fair value, we've been comfortable trimming some of those and then reallocating capital to other names in that subsector as well as to other subsectors. So continue to watch COVID in particular here. There are certain names within this subsector, equipment, supplies, and tools that may have longer term disruptions associated with their business models. So we track that fairly closely as well. And lastly, providers and services, smaller piece of our bench, but we do track the ebbs and flows in places like the wholesalers, the retailers, some of which have some structural challenges, we believe right now. But we do see some interesting valuation and interesting earnings growth potential commensurate with COVID in particular for the publicly traded health insurers. So we've got some exposure there. Next slide, please. So positioning coming into 21, we've had a good start to the year. We believe we have, again, a really well-balanced and well-constructed portfolio. Roughly 50 names in the portfolio, 52 here at year's end. As you can see in the green box, the valuation of those equities is pretty consistent with our bench. But interestingly enough, we're getting better earnings growth for that relative expenditure of capital. We can get PEs that are at or below the market with better earnings growth in the market. We find that an attractive portfolio that we think over long periods of time should continue to generate strong performance. And as you see at the bottom of the slide here, the industry allocations are fairly balanced. Some of the more extended subsectors, the smallest piece, healthcare technology, just simply put, been a bit of a challenge to find names there that make sense in terms of both growth as well as rational valuations. With that, I'll turn it back to you, Yvette.
Thank you, Steve. Healthcare is truly an exciting sector to be invested in right now. And I'm sure even after the pandemic, the healthcare sector will continue to outperform because of its relatively defensive nature, as you pretty much pointed out. Okay, just to pick both of your brains further, can you share with us how you intend to navigate your respective funds moving forward? Can you let our audience know what investment themes you're looking at, and what would bring growth opportunities to your funds moving forward? Maybe we can start with Steve. Your insights, please.
Sure. So broad themes for 2021 and beyond, frankly. We continue to look at demographics and the medical advances that support our aging population. Simply put, we are all aging. I'm going to show you a slide in a moment that kind of lays that out. And to the extent, again, that we simply use more healthcare products and services as we continue to age, this tailwind is unremitting. It is the type of thing that we believe lends to an allocation of capital for this very reason, that this sector, unlike many, does have a tailwind that will persist through good times and bad, even through the pandemic, for that matter. We continue to look closely, too, as I mentioned earlier, at things like unmet medical needs, one of our three guiding principles. See a lot of unmet medical need yet to be addressed. Things in the central nervous system, for example, diseases like Alzheimer's and Parkinson's. We don't have good treatments for today. And a lot of great science coming forward there. We're very excited about, as well as metabolic and obesity. Metabolic syndrome, type 2 diabetes, rampant in the Western economy today, akin to Western diets. We're tracking a lot of great advances there that we think will be fundamentally changing the face of those diseases. We mentioned as well in passing rare and orphan diseases, an interesting space with a very great amount of new capital flowing towards these opportunities, particularly in that IPO market I mentioned a little bit ago. So lots of places to look and lots of companies to track, and we're doing just that. I might turn to the next slide just to give you a little sense of how big these tailwinds could be. I mentioned aging. This is a little bit of a dated chart, but from the OECD. As you can see here, this is a listing of the 35 OECD countries and the population at or above 65 years of age. In 2010, those are the green bars. In 2050, those are the projected percent of the population in those countries that are at or above 65 years of age, which we consider kind of senior citizens. As you can see, broadly, kind of 12, maybe 15% of the population in 2010 was in that category. It more or less doubles over that 40-year time span, pretty much across the board with a handful of exceptions. That is just an unremitting trend that is a draft that will drive additional utilization in healthcare. If we go to the next slide, you can see this pretty graphically. These are data on the left from the United States Medicare program. This is the program for senior citizens, the health insurance program federally administered in the U.S. If you look on the left, when patients come into Medicare here in the U.S. at or around age 65, on average, they spend about $6,000 a year USD for their healthcare services and products. And by age 80, they've doubled to $12,000 a year. And if they live long enough, by age 90, they're up towards $16,000 a year. So as we age, things break down, and that trend just leads to a very strong demand curve for many of our companies. That, in a macro sense, as you see on the right side of this chart, is kind of laid out again. These are GDP numbers from 95 forward. Again, from the World Health Organization this time, but as you can see, all major developing markets and developed markets, we see kind of an unremitting climb in terms of their allocation to healthcare away from other parts of their economy. These are tailwinds that we don't expect to change anytime soon. I mean, with COVID, we've seen an uptick in every one of these charts here in 2020, and that will persist. We think it certainly into the early and mid part of this decade on the backs of COVID spending. Next slide, please. So lastly, those unmet needs, why are we so optimistic long term? I will tell you that these disease states, we still see just massive underserved patient populations. We've made some good progress in blood cancers, for example, over the last 20 years, but the solid tumors, we've had some inroads with immunotherapies and things of that sort, but an awful lot of patients that are still not well served by current treatment options. Metabolic syndrome, I mentioned a minute ago, huge problem in of itself. Type 2 diabetes is just an absolute pandemic in of itself. But it's amazing, too, when we look at things like COVID, at the intersection of these diseases. Many of you may know, if you've read the public press, folks with poor outcomes and high mortality from COVID are disproportionately often seen in these metabolic patient populations. So type 2 diabetics, obese patients, they simply have worse outcomes with COVID. So to the extent that we can curtail some of those metabolic challenges, certainly going to impact our COVID trajectories. Importantly, too, though, it has links to cancer, it has links to orthopedic surgeries. I mean, a lot of secondary effects from that disease state, and some fantastic new drugs coming forward there, one of which we just saw some fascinating data on just 3 weeks ago in one of our larger holdings. I mentioned rare and orphan, I may skip over that, but quickly, central nervous system disorders, Alzheimer's disease, I'd be remiss if I didn't mention, too. Just last weekend, we saw the first of these newer treatments for Alzheimer's. We've not had an Alzheimer's treatment approved in the developed world in 19 years, believe it or not. And the first of these new monoclonal antibodies to show statistically significant improvement in patients was unblinded for the medical community to review that data just this past Saturday. So very optimistic that we're going to make some inroads in certain of these diseases over the next 5 to 10 years. The combination, again, of those demographic tailwinds coupled, again, with these great scientific advances, we think bode very well for this industry. And accordingly, our takeaway, I think, is that any well-balanced investment portfolio probably wants some exposure to certain of these tailwinds. With that, I'll turn it back to you, Yvette.
Thank you, Steve. Wow, truly a lot of growth opportunities for the healthcare strategy. Okay, Paul, can we turn to you?
Yeah, so I mean, in terms of the themes that run through this portfolio, I mean, clearly it's an income-oriented portfolio. So the portfolio construction is a function of where we can get that yield from and that income from. But saying that, there are sort of 3 key I could say three key themes that sort of flow through the portfolio. One is to get exposure to, as I've mentioned, corporates that you can understand their cash flows a bit better. So as I've mentioned, telco services, there's a fair weight or a fair exposure, which is a key theme in the portfolio. The second, if we can turn to energy, I think we're well aware of how energy has rallied over the last sort of a few months as oil prices have risen, commodities have done fairly well. But also we look at some of those corporates as well. So within energy, you have, say, midstream energy businesses. So I give you an example here. You have a gas pipeline company. That gas pipeline company will be paid on the amount of cubic meters of gas that flows through its pipes. And therefore you get a better idea of, again, the cash flows that are generated from transporting or operating that pipeline. So that is another area, again, where we look to, which is a key theme for the portfolio. And then the third theme is, again, I've talked about it before, on the equity bucket as well as the fixed income bucket. This portfolio is very much positioned to the reopening of economies. So another key theme that we have in this portfolio is exposures to, or more recently we've added on the high yield side, is exposures to fitness center chains. We've also added to food and protein producers. We've also added into tourism names, energy names, and that's in both emerging markets and the US. So they're the sort of the key three themes that I've mentioned. Maybe I can hand back to you, Yvette.
Exciting for both portfolios. Wow. Thank you, Paul and Steve, for your very comprehensive and truly insightful answers. And thank you to our dear audience for staying with us after so long. But wait, before we proceed to the Q&A, I would like to take this opportunity to acknowledge our media guests who are joining us from the audience, namely ANC, Philippine Daily Inquirer, Philippine Star, Rappler, Reuters, Business Mirror, Manila Standard, and Philippine News Agency. Thank you very much for joining us today. At this point, we'd like to open the virtual floor for some questions or clarifications that you may have for either guests. Okay, we have quite a lot of questions actually. Okay, this is for Paul. The first question is for Paul. Wait. Oops. Okay. You mentioned earlier that one of the non-traditional sources of income for the fund is call options. So how do you manage the risk of writing call options that becomes in the money at expiration date?
Yeah, sure. So again, it's an interesting part of the portfolio. So, and it does warrant a little bit more explanation. So this portfolio doesn't own any calls or puts. So we don't own any of these calls or puts. So it isn't a strategy that benefits from, or we're levered towards the upside of markets or the downside of markets. This portfolio sells or writes calls and puts, and therefore we would get a premium or an income harvested every time we write a call, every time we write a put. So the question is around what happens when at expiry those calls and puts are in the money, and what do we do about that, and how does the fund pay out that if we're struck out? So we should highlight here and be clear about this is that these are covered calls and they are collateralized puts. So what we mean by that is the calls are written on a basket of equities in the portfolio. So if the calls are, so ultimately what a covered call is, you are long the stop and you are short the call. So if we are struck out on the call side, we would have to deliver those equities to the client, and ultimately we have those already because we have those already in the portfolio. Similarly, on the put side, we would collateralize the value of those puts by posting cash with a broker, and if we're struck out on the put side, that cash will then be given to the broker. We may even post treasuries as well as collateral for those put. So in many ways, this isn't an ownership of puts and calls strategies. Maybe there's often a sense of a misinterpretation that this portfolio is sort of leveraging through derivatives, puts and calls, but it's not here. It's a selling of selling puts and call strategy, writing those, and they are covered on the call side and they're collateralized on the put side. So that hopefully answers the question of once they expire in the money, there is collateral there to pay out if needed. And ultimately, I should also add, we would generally expect to retain the premium on only one side of the puts or calls.
Mm-hmm.
So if the market goes up, the calls are struck out, we retain the put premium. The market goes down, the puts are struck out, we retain the call premium. In a range-bound market, we would generally keep both of them, and that would be ideal for that portion of the portfolio. So hopefully that answers your question, Yvette.
Yes, thank you for the clarification. Yes. Okay. Wait. Here's an interesting question for Steve. Steve, since vaccine rollouts have already started, do we expect more upside on the pharma names who are ahead of the others, like Moderna, Astra, Pfizer, and J&J? Do you think that Yes? Do you think that being overweight, sorry, there was a follow-up. Do you think that being overweight on these companies could substantially help the overall performance of your fund?
It's an interesting question. Thank you for the question. It is noteworthy that several of the larger companies that have rolled out vaccines, including Pfizer and Johnson & Johnson and AstraZeneca, have relatively underperformed, believe it or not, since these products came to market. The smaller cap names, the Modernas and BioNTechs, for example, have been fairly volatile, but relatively strong performers. And a great case study. How do you take advantage of the potential upside here? I'll tell you, one of the things we have done in this portfolio is we've taken two positions in two manufacturers of vaccines. Many of these folks have great science, but they don't have manufacturing footprints, particularly these emerging biotech companies. And they rely on an industry called the CDMOs, the Contract Development and Manufacturing Organizations, to kind of backfill that basic blocking and tackling of getting the vaccines made, put into vials and things of that sort. So we've actually done quite well with those names for the simple fact that not only will they have a sustainable stream of revenue, we believe, for probably at least 2 to 3 years and potentially longer if we need booster doses. But that capacity, once it is used up and hopefully we get the globe vaccinated, can be redeployed then to other biologic drugs, other cancer drugs, things of that sort. So there's a nice sustainable revenue stream from that CDMO perspective that might not be there from some of the pure play vaccine bets. So, hard to predict exactly which stock will go where at any given time. But the other thing I think one would have to bear in mind, for the large diversified companies, the Pfizers and the Johnson & Johnsons, for example, the vaccine is but one component of what drives those equities, right? J&J has over $60 billion of sales a year. Pfizer's well over 40. So whatever vaccine sales they have, we would consider in the broader context of what their revenues and profits look like for the aggregate, the kind of legacy business as well. And those pieces are equally, if not more important, probably because many of those are longer tailed assets, right, when we think about a discounted cash flow model. Hope that helps a bit.
Yes, it does. Thank you, Steve. Okay, let's move on. The next question will be for Paul. Okay. Aside from COVID-19 being the biggest risk for global markets, what other risks could affect our investments this year, and how are the funds positioned to mitigate these? Paul?
Yeah, sure. So I think we're well aware that the key drivers for this year, and this plays into the risk question, the key drivers this year are obviously the Fed and the dollar, where rates are going, and in this part of the world, China. So there's obviously risk in all three of those areas, and how we sort of navigate guidance from the Fed, what sort of inflation data we're going to get over the coming 6 to 12 months is also a key risk. I think we're well aware that inflation our expectations are rising, but is actually inflation sort of sustainable, or will we just get a high print in Q2? I think many of us are expecting a higher print in Q2, given when you compare back to Q2 in 2020, which was deep COVID, that could potentially be sort of impacting markets or spook markets in many ways if the Fed doesn't do anything about it. I think the Fed has guided us to expect rates to still remain lower for longer, so that's a positive side. But obviously the pathway of COVID and the success of these vaccines are key to reopening these economies. And still out there are variants. And I think we shouldn't be have scares or fear mongering here, but how that develops over time and how the vaccines are able to mitigate the risks with these variants is obviously key to this reopening of these economies. I think another area which is worth mentioning, which is something that we haven't talked about over the last year because COVID has dominated the headlines, has been geopolitics. So those relationships between East and West, China, the US, and how that develops over time. Those relationships are probably not the best as they potentially should be if we're talking about global integration and global economies. And if we're going to go down the road of deglobalization, how does that impact supply chains, certain sectors? And obviously to manage those changes in that global environment, that will obviously impact portfolios, and we have to be nimble to navigate through those risks as well, and to asset allocate between these sectors. I think also be aware that, and I talked about it maybe before, I touched upon it, this medical solution is not necessarily an economic solution. I think global economies still need that fiscal stimulus. They still need that monetary stimulus. And you can ask the question, is that enough? And have economies done enough to really bring their economies back to where they should be? We're clearly well below pre-COVID growth levels. So, whereabouts on that curve do we get back to those pre-COVID growth levels? And that is a key thought or consideration into how we look at risk assets. How's the Fed going to react? Are we going to get inflation? What are the Fed going to do about it? So these are obviously fluid variables over the year. But I think at this point in time, over the very near term, I think we're happy with the guidance we got in terms of if you are invested into risk assets. I think you would be happy with what you heard from Chairman Powell over last night. So I'll leave it there. I think things are still reasonably positive, a good runway for risk assets, but clearly there are risks still out there. Yeah.
Noted on that, Paul. Okay, we have a lot more questions, and but in the interest of time, I think this will be the last question, and it goes to Steve. This looks interesting. Okay, let's just say COVID-19 will be gone by next year, and we can all return to our normal lives. What aspect of global healthcare will the fund be focusing on now after the pandemic has passed?
Great question. I highlighted a few in my presentation, Yvette, but the simple fact is that the COVID is one of 30 unmet medical needs that we're tracking. Right? So to the extent that we can get back to some sense of normalcy, that patterns of practice come back and patients are in the offices again and surgeries are being conducted at normal levels, I think Paul makes a great point, right? I mean, you may get a medical fix, but there are economic fixes that still need to occur within the ecosystem of healthcare that have not yet occurred. So that is something we will track closely. Utilization in a macro sense is still depressed, meaningfully depressed globally, and certainly in developed markets. I think we will track the shift from the pandemic to the endemic. And what I mean by that is we may get COVID under control, but I think most public health experts that we speak with, epidemiologists, immunologists, have pretty much come to the conclusion that COVID will be with us going forward, kind of like the influenza or the flu is with us now on kind of a seasonal basis globally. Currently in the Southern Hemisphere, it's very suppressed because of tail end of their flu season. Everybody's been masked, everybody's social distance. But this disease, like flu, like RSV, there are other respiratory viruses, they will be likely with us long term. And there are unknown health considerations around COVID, right? There's much discussion around long haulers, patients who have persistent symptoms as a result of their COVID infection. And the long-term health implications of that are really uncharted waters, right? So we're going to track the literature closely and see what transpires there. I mean, just a fascinating case in point. I read last night a study from The Lancet, one of the top journals in England, the medical journal. So it's showing a case study of a gentleman who was infected with COVID, had a persistent infection, and eventually developed rheumatoid arthritis, which is an autoimmune disease where the body's own B cells attack and antibodies attack the joints in a person's body. Unclear if it's causative, but those are the types of things that we'll be charting going forward and tracking. But just to close, we think that this can be managed. I'm optimistic that we can get these vaccines out and get it under control. And then maybe it's back to normal in the other 29 diseases that we really have unmet needs for, like I mentioned, Alzheimer's, diabetes. I mean, I can't stress strongly enough that as much progress as we've made in healthcare over the last 50 years, I think there's an equal amount of unmet need to address in the next 50, and hopefully it won't be 50, it'll be 20 or 15 or 10. The acceleration of science, acceleration of genomics, I think will compress those timelines. And that really leads to an interesting investment opportunity, we think, for balanced investors. Thanks, Yvette.
Thank you, Steve. Thank you very much. We have a lot more questions, and it's truly inspiring to be in an event with such engaged viewers. Thank you again to those who have sent in their questions, and I hope you got great insights from our guest speakers. And with that, we close our Q&A session, and the time has come for us to announce our 2 lucky winners to receive 5,000 pesos worth of investments to any of our best performing unit investment trust funds. Okay, our first winner is congratulations, Miss Fe Omadle. You have 5,000 pesos worth of investment into any of our funds. And I hear we have drawn our second winner. Congratulations, Mr. Ray de los Reyes. You also have won 5,000 pesos worth of investment into any of our funds. Congratulations to Ms. Fe Omadle and Mr. Ray de los Reyes. A representative from the marketing team will be reaching out to you to tell you how to claim your prize. And just a reminder for both of our winners, you must submit the necessary requirements to commence the application process for your initial investment, okay? Oh, and speaking of prizes, get a chance to win Apple gadgets when you invest in any of our UITFs via our digital tool, Manulife iFunds. Every 5,000 pesos or $100 worth of investments entitles you to 1 raffle entry for a chance to win an iPad Pro, an iPad Air, or an Apple Watch. Promo period is from March 15 to June 30, 2021. So what are you waiting for? Invest now. Talk to your Manulife Wealth Specialist or financial advisor if you need further investment advice. And if you don't have a wealth specialist yet, don't worry. You can scan this QR code and a wealth specialist will be in touch with you soon. Okay, thank you again to all our viewers who have stayed with us to the very end of the program. And of course, thank you very much to our esteemed guests, Paul and Steve, for your valuable time, your knowledge and your insights that you've shared with us. Before we end this program, maybe you would want to give any final message to our audience. Paul, can we start with you?
Sure. So yeah, very quickly then, congrats to the winners. Hopefully it's a profitable year for you in 2021. So that's great. And just in terms of wrapping this up, I think ultimately from Manulife, we're a big believer in income strategies, whether they're sort of pure fixed income strategies or they're pure preferred security strategies, or in this case, multi-asset solution strategies. So, given the global environment that we're in, yields might go up a little bit, but ultimately yields will still remain fairly suppressed. And therefore, these income-oriented strategies should do fairly well over the sort of next few years. So that's our sort of thoughts around that. So yeah, I wish you a happy, healthy, and wealthy 2021. Goodbye from me, and I'll hand back to Yvette.
Thank you very much, Paul. Steve, any final words?
Yeah, thank you, Yvette, and thank you to all our participants today. It's been a real pleasure to be with you all, and thank you for the excellent questions, by the way, as well. Just want to recap, we are very optimistic. I know it's been a trying year for many folks in terms of their own personal situations. The global healthcare arena has been front and center this past year and will be likely here in 21 as well. We think that we're making some good progress there, though. I'm encouraged by some of the developments that we've seen from a scientific standpoint. And those, to the extent, again, they help inform our investment opportunities. I really feel that out of the challenges of COVID, there are some handful of good things that may come from it, one of which is these advances in science help inform new trajectories for our industry. And we think that's a great place to consider allocating capital, simply put. And if you're looking, again, for high growth and consistent outperformance over time, coupled again with a defensive backstop in a very high conviction portfolio, frankly, where we've done the work, we've done the bottoms up work. We believe that we have investment insights that are not recognized broadly by the market in almost every name we hold. We think this would be an interesting time to take a hard look at this product and encourage you to reach out to our contacts there in the Philippines should you have additional questions in that regard. Yvette, thank you very much. Great to be with you.
Thank you very much, Steve. And thank you again for staying up for us. You know, making financial decisions, especially when markets remain volatile and uncertain, it's a very challenging task. But being informed of alternative investment options like multi-asset strategies and global healthcare strategies, knowing that they're out there and keeping updated of current market developments, it can help you better navigate this kind of market. So we hope the information that our guest speakers shared with you can help you make sound decisions in the future. And know that just by joining this webinar today, you've actually taken your first step in making your everyday better. Thank you again for joining us today. But before we go, we would like to get your feedback about this event. Please answer our short survey by scanning the QR code that will be flashed. There is flashed on the screen. Answering the survey will allow us to continue delivering helpful webinars like this for you in the months to come. Again, this has been your host, Yvette Marquez Carlos, and on behalf of Manulife Asset Management and Trust Corporation, we hope to see you again in our next webinar. Thank you and enjoy the rest of the day. Bye.
Now more than ever, healthcare has become a top priority. Benefit from this sector's robust growth opportunities. Manulife Global Healthcare Equity Feeder Fund, an equity UITF structured as a feeder fund that provides investment opportunities in healthcare-related companies listed globally. Invest now for as little as 5,000 pesos or $100 US. Talk to a Manulife Wealth Specialist today. Generate income from traditional and non-traditional assets. Benefit from a broad investment universe. Diversify your investment portfolio with Manulife Global Multi-Asset Diversified Income Feeder Fund, a unit investment trust fund that provides a flexible and diversified investment strategy, blending multiple income sources to maximize your returns. Invest now for as little as 50,000 pesos or $1,000 US. Talk to a Manulife Wealth Specialist today.
is changing, and investors around the world are becoming more sophisticated, demanding innovative solutions from wealth and asset managers. Combining our deep expertise and experience in both investment and wealth management, Manulife Investment Management offers fully integrated solutions spanning investment funds and pensions globally. Strategically positioned in key markets, our investment and client service operations are supported by seasoned investment professionals across the globe. Today, we are one of the leading global wealth and asset managers. What sets us apart is our 3 complementary global business lines to meet the unique needs of our clients. With our multi-product and multi-channel offerings, our retail investments arm brings institutional capabilities to retail investors, creating unparalleled investment solutions. While our institutional asset management arm provides a comprehensive suite of outcome-oriented solutions to institutions internationally. Our retirement arm offers an open architecture platform, which aims at providing best-in-class products and end-to-end solutions to meet the varied retirement needs. Leveraging the strength of our parent company, Manulife Financial Corporation, which has a rich heritage and investment track record that dates back to the 1800s. We have access to a wealth of experience. With our strong insurance pedigree, we manage risks in a strategic and dynamic way. In Asia, our unrivaled presence and deep understanding of the region enable us to offer strong local insights and flexibility in customizing solutions for every client. It is our unwavering commitment in Asia that makes us a trusted partner of many across the world. Leveraging our local level expertise, as well as extensive global resources and network, we deliver solid investment results not just in public markets, but also private markets. Our long track record and deep capabilities in private assets means you can tap into a diverse group of assets to meet your unique investment needs. Through our differentiated, value-added public and private asset offerings and capabilities, we punch above our weight in delivering outcome-oriented and goal-based investment solutions to our clients. We achieve excellence in Hong Kong, where we power the largest mandatory provident fund provider, Manulife, and China, where we are the first financial institution to receive the investment company wholly foreign-owned entity license. The Philippines, where we are the first trust corporation backed by a leading multinational financial services group. And Indonesia, where we were awarded the top fund house. And this sums up our commitment to you. Manulife Investment Management.
Now more than ever, healthcare has become a top priority. Benefit from this sector's robust growth opportunities. Manulife Global Healthcare Equity Feeder Fund, an equity UITF structured as a feeder fund that provides investment opportunities in healthcare-related companies listed globally. Invest now for as little as 5,000 pesos or $100 US. Talk to a Manulife Wealth Specialist today. Generate income from traditional and non-traditional assets. Benefit from a broad investment universe. Diversify your investment portfolio with Manulife Global Multi-Asset Diversified Income Feeder Fund, a unit investment trust fund that provides a flexible and diversified investment strategy, blending multiple income sources to maximize your returns. Invest now for as little as 50,000 pesos or $1,000 US. Talk to a Manulife Wealth Specialist today.